You want to know the single most powerful investing strategy that almost nobody talks about correctly? It's not some secret hedge fund algorithm. It's not options trading. It's not finding the next Tesla before everyone else does. It's literally just buying the same thing over and over again on a schedule, like a robot that doesn't care about headlines, earnings reports, or whatever doomsday prediction is trending on social media this week. It's called dollar cost averaging, and the reason most people either ignore it or misunderstand it is because it sounds way too boring to actually work. But here's the thing, it works. It works incredibly well. And by the end of this video, you're going to understand exactly why, how to do it properly, and why the math behind it is borderline unfair in your favor. Let me paint you a picture. It's March 2020. The world is shutting down. The S&P 500 just dropped 34% in about 4 weeks. Your portfolio looks like it got hit by a freight train. Every financial talking head on TV is screaming about the end of the world. Your coworker panic sold everything and put it in a savings account earning 0.5%. Your uncle is texting the family group chat about how he knew this was coming, even though he definitely did not know this was coming. Now imagine two people in this exact moment. Person A freaks out, sells everything, and waits for the right time to get back in. Person B doesn't even look at their portfolio. They just keep investing $500 a month into an S&P 500 index fund like they've been doing for years. Fast forward to today, and the S&P 500 has returned over 23% in 2024 and another 18% in 2025. Person B didn't just recover, they bought shares at a massive discount during the crash and rode the entire wave back up. Person A? They're still waiting for the right time, which apparently hasn't arrived in 5 years. That's dollar cost averaging in action. But let me actually break down what it means so we're all on the same page. Dollar cost averaging is simply investing a fixed amount of money at regular intervals, regardless of what the market is doing. Every 2 weeks when you get paid, you invest $200 into your index fund. When the market is up, your $200 buys fewer shares. When the market is down, your $200 buys more shares. You don't think about it. You don't analyze it. You just do it. And here's the mathematical magic that makes this strategy so powerful. Because you're buying more shares when prices are low and fewer shares when prices are high, your average cost per share ends up being lower than the average price per share over that same period. Read that again because it's the key to everything. Your average cost will always be lower than the average price, as long as there's any volatility at all, which there always is. Let me show you with actual numbers because I know some of you don't believe anything until you see the math. Say you invest $500 every month for 5 months. Month 1. The stock is at $50 per share, so you buy 10 shares. Month 2, it drops to $40, so your $500 buys you 12.5 shares. Month 3, it crashes to $25, so you're picking up 20 shares at a discount. Month 4, it recovers a bit to $40, so you get 12.5 shares again. Month 5, it's back to $50, so you buy 10 shares. You invested $2,500 total and own 65 shares. Your average cost per share, $38.46, but the average price of the stock over those 5 months was $41. You paid less than the average, every time. That's not luck. That's math working in your favor because you kept buying when everyone else was running for the exits. Now, I know what some of you are thinking, but wouldn't I make more money if I just invested everything at once when the market was at the bottom? Yes, if you could perfectly time the market bottom every single time, you'd make more money. You'd also be a time traveler or a liar, because nobody can do that consistently. Charles Schwab actually ran a fascinating study on this. They looked at 5 different investing approaches using $2,000 per year over 20-year rolling periods. The first approach was perfect market timing, investing at the absolute lowest point every single year. The second was just investing immediately on the first trading day of each year. The third was dollar cost averaging, splitting the $2,000 into monthly installments. The fourth was the worst possible timing, investing at the market's peak every single year. And the fifth was just staying in treasury bills and avoiding stocks entirely. Here's what blew my mind. Perfect timing over 20 years, $186,077. Investing immediately without thinking, $170,555. Dollar cost averaging, $166,591. Now those top 3 results are remarkably close, especially when you consider that perfect timing is literally impossible to achieve consistently. But here's the number that should terrify you. The person who just stayed in treasuries because they were too scared to invest in stocks? They ended up with around $82,000. That's over $100,000 less than even the worst stock market timer. Let that sink in. Even the person who invested at the absolute worst possible moment every single year for 20 years still crushed the person who stayed out of the market entirely. The cost of not investing dwarfs the cost of bad timing. And that brings up Vanguard's research. which I think is one of the most honest pieces of financial analysis out there. Vanguard studied markets across the globe and found that lump sum investing, just throwing all your money in at once, outperformed dollar cost averaging about 68% of the time. So about 2/3 of the time, you'd be better off just investing everything immediately rather than spreading it out. Some people hear that and think it means DCA is a bad strategy, but they're completely missing the point. The 68% stat is about what's mathematically optimal when you already have a lump sum of cash sitting around. For the vast majority of people, that's not the situation they're in. You don't get your annual salary handed to you in a briefcase on January 1st. You get paid every 2 weeks, you save a portion, and you invest it. That's dollar cost averaging by default. It's not a compromise. It's how normal people actually build wealth. Here's something else nobody talks about. Dollar cost averaging isn't just a math strategy, it's a psychology strategy. And honestly, that might be more important because the number one enemy of long-term investing isn't fees or taxes or even bad stock picks. It's you. It's your emotions. It's the panic selling when markets drop 20%. It's the FOMO buying when your neighbor won't shut up about the crypto he bought. Behavioral finance research has shown over and over again that individual investors consistently underperform the market by about 1 to 2% annually, not because they pick bad investments, but because they buy high out of greed and sell low out of fear. Dollar cost averaging removes the emotional decision-making from the equation entirely. You invest on the schedule, period. The market had a bad week? Doesn't matter. You invest. The market hit an all-time high? Doesn't matter. You invest. Your favorite financial YouTuber is predicting a crash? Doesn't matter. You invest. The automatic nature of DCA is its real superpower because it turns you from an emotional, reactionary investor into a disciplined, systematic one. Let me give you a real-world example that drives this home. If you invested $500 per month into an S&P 500 index fund starting in January 2005, right before the worst financial crisis in modern history, and you just kept going through 2008 when the market dropped over 50%, through 2020 when COVID crashed everything, through every scary headline and recession fear, by the end of 2025, you'd have invested $126,000 total. Your portfolio, worth roughly $380,000. That's $254,000 in pure investment gains, more than tripling your money. And the person who panicked in 2008 and stopped investing for even 2 years missed some of the best buying opportunities in stock market history. Those shares purchased at the bottom of the 2008 crash would be worth 4 to 5 times their purchase price today. Missing those opportunities by trying to time the market is like skipping the sale of a lifetime because you thought prices might drop even more. And by the way, during the 2008 financial crisis specifically, someone with a balanced portfolio who kept contributing $15,000 a year through automatic investments took about 52 months to fully recover to their pre-crash portfolio value. That sounds like a long time, and it is. But the person who stopped investing during the crash? They took even longer because they missed out on buying shares at rock-bottom prices. The people who kept dollar cost averaging through 2008 and 2009 were picking up shares of incredible companies at once-in-a-generation prices. Those discounted shares then multiplied in value during the decade-long bull run that followed. That's the hidden advantage of DCA that nobody appreciates in the moment. Market crashes aren't just something you survive. If you keep investing through them, they become the foundation of your future wealth. Now let me talk about where DCA really shines versus where people abuse it. DCA is perfect for broad market index funds. The S&P 500, total stock market funds, total world funds. These are investments where you can be reasonably confident that over decades, the value is going up. The S&P 500's average annual return over the past 30 years has been about 9% before inflation. It doesn't go up in a straight line, but the long-term trend is undeniably upward. DCA into these types of investments is basically printing money in slow motion. Where DCA gets dangerous is when people use it to justify buying garbage. I've seen people dollar cost average into meme stocks, into single company stocks that are clearly declining, into speculative crypto tokens that don't even have a real use case. Dollar cost averaging into an asset that's going to zero doesn't save you. It just means you lose money more slowly. DCA works because the underlying asset is expected to appreciate over time. If you're averaging down on a sinking ship, you're not being disciplined, you're just buying more tickets on the Titanic. Here's another scenario where DCA is unbeatable, and it's one that applies to most people watching this. If you're contributing to a 401k or similar retirement plan, you're already dollar cost averaging whether you realize it or not. Every paycheck, a percentage goes into your retirement account and gets invested. You don't choose the timing. You don't analyze the market conditions. It just happens, and the data shows it's working. The average combined savings rate for 401k plans, including employer contributions, hit a record 14.3% in early 2025, according to Fidelity. Baby boomers are contributing about 12% of their income. Gen X is at about 10%. Millennials are around 9%, and Gen Z is at about 7%. Every single one of these groups is dollar cost averaging by default, and the ones who started earliest and stayed consistent are sitting on the largest balances, not because they picked better investments, but because they gave DCA more time to work its magic. Speaking of time, let me show you why starting early with DCA is so absurdly powerful. If you start investing $400 per month at age 22, earning an average 8% return, by age 62, you'll have roughly $1.3 million. If you wait until age 32 to start the exact same $400 per month, you'll end up with about $590,000. That's a $710,000 difference just from starting 10 years earlier. You contributed an extra $48,000 over those additional 10 years, but compound interest turned that into an extra $710,000. That's nearly a 15x return on the money you invested in those early years. The math is so lopsided it almost feels unfair. Your 20s are the most valuable investing years you'll ever have, and most people waste them because they think they need to know everything about the stock market before they start. You don't. You just need a target date fund or an S&P 500 index fund and the discipline to invest consistently. That's it. The knowledge comes later. The time you waste waiting for that knowledge is worth far more than the knowledge itself. Now I know someone is going to bring up crypto, so let's address it. If you had dollar cost averaged just $10 per week into Bitcoin starting in 2019, by 2024, your total investment of about $2,600 would be worth roughly $7,900. That's a 202% return. And yes, Bitcoin is volatile enough to make your stomach turn inside out. But DCA smoothed out all of that volatility. You bought Bitcoin at $4,000, and at $60,000. And at $17,000 during the crash and back up again. Your average cost per Bitcoin ended up being significantly lower than if you tried to time any of those wild swings. Now, I'm not telling you to go dump your retirement savings into crypto. This isn't financial advice, and anyone who tells you crypto is a guaranteed path to wealth is probably trying to sell you something. But the DCA principle applies to volatile assets even more powerfully than stable ones because the volatility creates bigger discounts that DCA can exploit. There's one more practical tip that can turbocharge your DCA strategy, and it's something most financial advisors won't mention because it's almost too simple. Whenever you get a raise at work, increase your automatic investment by at least half the raise amount. If you get a $200 per month raise, bump your investment up by $100. You'll barely notice the difference in your spending because you were already living on the lower amount, but over time, those incremental increases compound dramatically. Someone who starts at $300 per month and increases by $50 each year will end up with significantly more than someone who stays flat at $300. Not just because they invested more in total, but because the earlier increases had more time to compound. It's like giving your DCA strategy a growth engine instead of leaving it idling in neutral. Let me wrap this up with the biggest misconception about dollar cost averaging that I hear all the time. People think DCA is for beginners. They think it's training wheels for real investors. They think once you get good at investing, you'll graduate to market timing and stock picking and option strategies. And that is completely wrong. Warren Buffett, the greatest investor of all time, has explicitly recommended that most people just invest consistently in a low-cost S&P 500 index fund. He even made $1 million bet that a simple index fund would outperform hand-picked hedge funds over 10 years. And he won that bet by a wide margin. The entire concept of dollar-cost averaging into index funds is endorsed by virtually every credible financial institution, from Vanguard to Fidelity to Schwab. It's not a beginner strategy, it's the strategy. So here's your action plan. Figure out how much you can invest per paycheck. Set up automatic transfers to a brokerage account. Pick a low-cost index fund, preferably a total market or S&P 500 fund with an expense ratio under 0.1%. And then forget about it. Check it once a quarter if you must. Don't check it daily, don't panic when it drops, don't get greedy when it spikes. Just keep feeding the machine. In 10 years, you'll look back at your portfolio and wonder why you ever considered doing anything else. The people who build real, lasting, generational wealth aren't the ones making flashy trades and timing the market. They're the ones who showed up every 2 weeks, invested their money, and let compound interest and dollar cost averaging do the heavy lifting. It's boring, it's simple, and it works better than almost anything else you'll ever try. If this video helped you understand why consistency beats complexity when it comes to building wealth, make sure to subscribe because we break down money concepts like this every week. The people who watch these videos and actually apply them, they're the ones who end up financially free while everyone else is still trying to outsmart the market. Don't be everyone else.